important accounting terminologies. Okay, so basically for preparing your books of accounts, right from your journal ledger and even the financial statements, balance sheet, everything, you must know what is meant by that terminology. Then only you can come to know where we have to post or where we have to bring it over. Okay, so in this session, we are going to discuss first that one only. So if you see what are the important terminologies, first comes the assets. So actually, if we see the assets means actually they are being classified into fixed assets, current assets, tangible assets, and intangible assets. So basically, assets means the property which is owned by the business. So the properties that are belonging to the business, properties that are purchased and which is in the business, that is known as the assets. Okay, so generally assets will be appearing in the balance sheet. Okay, so assets can be classified into fixed and current assets. So what is meant by fixed asset? Fixed asset is one which I am purchasing right now, like plant and machinery or land and building. Those types of assets I am purchasing it now, but its benefit will be given for the future. Say for 5 years or 10 years, I'll be holding those assets. And if I want to sell those assets, actually it takes some time for me to convert into cash. So such kind of assets are known as fixed assets. So fixed assets, again, let me tell out, fixed assets can be like plant and machinery, land and building, furniture, all those are belonging to fixed assets. So now what is meant by this fixed assets? So fixed assets are those assets which cannot be converted into cash immediately. So within one accounting year, you cannot convert them into cash immediately, and it involves huge amount to invest, a huge amount you have to invest to purchase it, and you'll be holding it for a longer period of time. So immediately, if you want to sell, you cannot convert them into cash. So those assets are known as fixed assets. And next is the current assets. So current assets, it can be converted into cash immediately within one accounting year. So if I want to sell that, or if I want to convert into cash, I can immediately do that. So fixed assets, if you see, it is a long term in nature. You're going to hold in business, but current assets are of short term in nature. You can, if you think, or if you want to just convert, if you think itself, you can easily convert within a period of 6 months, or say for 1 year, you can easily convert. So usually the examples of current assets will be your cash, your liquid cash, your whatever you have it in your hand, that cash can be treated as current asset. And whatever the deposits that you are making in the bank, in bank account, you as a business, you'll be depositing your money into the bank account. Okay, so you'll be having a current account or something. So you that also can be withdrawn quickly. Okay, you can withdraw the amount whatever you have deposited in your bank. So that also comes under the current assets only. Okay, so okay, and your current assets. Your current assets usually cash in hand and cash whatever you have deposited in bank. So that is known as bank balance. And debtors, we will tell it as debtors. So let me explain in detail while coming here what is meant by debtors, all those things. So debtors, and then bills receivable, all those stock or the inventory. That is yet to be sold. Okay, so you have not sold, you have produced the product and you are keeping in your warehouse or godown or in a factory. So that can be also considered as current assets. So fixed assets, it is a long term in nature. Its benefit is spread over for a over a period of time, whereas current assets which you can convert into cash immediately, so you'll be holding less than 1 year. And fixed assets examples are your plant and machinery, land and building, furniture, etc. And your current assets will be your cash, bank balance, and then your debtors, bills receivable, stock or the inventory. Some short-term investments also can be considered as the current assets. Okay. Before moving on to that, let me tell out data. I have introduced one thing called data. Now, who is this data? So, if I am starting or operating a business, I may not make every sales for cash. Some, if I want to expand my business or for a large scale or large number of customers, if I want to see, then I have to surely sell the goods even on credit. So every time I cannot sell the goods on cash. If I sell means then number of customers will be small. Majority of the customers, they like to have credit facility. They need to buy the product, but they may not pay you now. Later on, they may pay after 3 months or something like that. Okay. So those people whom I have sold on credit to those customers, they have been named as debtors. Okay. So they receive benefit from us. Okay. So they receive benefit, money or money's worth. Usually we in definition we will be telling like that. Okay. So they will be receiving benefit from us. From if I am running a business, from the business, those customers whom I have sold on credit basis, those customers I will name it as debtors because they have to pay me in future. They have got benefit from me now, but they will be paying in the future. So those people are known as debtors. So data usually if they make prompt payment, then there is no difficulty for the business. If they are not making prompt payment, if they have become insolvent, that is insolvent means they don't have enough capacity to pay the debts. Then in that situation, whatever I have given sold on credit, everything becomes a loss and it is considered as the bad debts there. Okay, so that all we can later on discuss. So far we have seen what is meant by asset. They are the properties which are owned by the business, and assets can be classified into fixed and current assets. Fixed assets you will be holding for a long period of time and benefit will be for a long period of time and you cannot convert into cash immediately. Whereas current assets is that which you can convert into cash immediately within one accounting year, and those assets are holded for a short period of time. Okay, so next we are moving on to the liabilities. So what is meant by liability? Okay, so generally assets and liabilities will come under the balance sheet. So what is meant by liability? Liability means the loan or the debt or which has to be paid by that company to the outsiders. So take for example some loans they would have brought from the banks, some from financial institutions like that they would have got the loan. So in order to run the business smoothly, they would have got a loan. So liabilities means the loan or the debt or the obligation which has to be met by the firm or by that particular company. So those are known as the liabilities. So liabilities generally appear in the balance sheet. So balance sheet, under that you will be having a liability side and the asset side. Okay, so here liabilities can be further classified into current liabilities and long-term liabilities. Current liabilities, like how we have seen with the current assets, similarly current liabilities we have. So what is this current liabilities means? Short-term obligations. So you have to pay them immediately. Okay, so you have to pay them immediately within one accounting year. Okay, within that financial year, you have to pay them short-term liabilities. Okay, sometimes I might get goods on credit basis or some raw materials on credit basis from suppliers. Okay, so if I want to do business, I require the inputs to produce the product. So that basic raw material, everything will be purchased by me. Yeah, not every time I can buy it in cash, because if I am sanctioning credit to the customers, then obviously I don't have cash, or for circulating for normal routine business, I need some cash, and I couldn't invest everything in the raw material. So what I will be doing is that from suppliers, I will be buying the raw materials on credit basis, on credit purchase. So in that situation, a creditor will be coming into my business. So those people is known those who have given me, that supplier who has given me, no, so that person is named as creditor. So that creditor or the supplier who is sanctioning me credit, I have to make him payment immediately, or within 3 months or 6 months, within 1 year I have to pay him. Then only again, if I want raw materials, again I can purchase. So some agreement like that will be there. Okay, so they have to every now and then meet out those dues. Okay, so like this, current liabilities are there. So current liabilities means you have to pay or meet that short term obligations or dues that has to be fulfilled immediately, that too within one accounting year. Like that, if you see creditors, bills payable also, it comes under the current liabilities only. And then here in current assets, I told whatever deposits you make it in bank, that can be treated as a current asset. If I am holding a bank account, and if I am depositing a cash, whenever I require, I can withdraw, I can transfer, I can withdraw from it. So that is current asset. Similarly, current liabilities, you will be having the bank overdraft. So what is meant by bank overdraft is that it is a limit which is sanctioned for the business people, for the proprietor. So below, if he is having low limit in his account, even he is able to withdraw above that amount, or he can withdraw more than that. So that facility is provided to the proprietor, since he has to run his business smoothly. He has been provided with the overdraft facility. So bank overdraft, it has also to be paid immediately. So that's what bank overdraft will be coming under current liabilities. And bank balance, bank deposits that you are made will be coming under the current assets, and bank overdraft will be coming under current liabilities. Okay, so then moving on to the long term liabilities. So that is more than 1 year. So if I got some loan for 5 years or 2 years or 10 years like that, those can be considered as the long term liabilities, bank loan. And sometimes debentures are also considered as the long term liabilities. So what is meant by debenture? If I want to raise funds, okay, so if I am not capable enough to contribute capital, that situation, I will, as a company, what I will be doing is that I'll be issuing shares to the public. Similarly, debentures is also an instrument which is issued to the public. Okay, so from that we can raise out the funds. Okay, so it is treated as a debt only. Debentures are treated as debt. Okay, you have to repay them back. So under that, redeemable, something, many are there, irredeemable, everything are there. So generally debentures will come under the long term liabilities. That's all we require here. So liabilities means current liabilities and long term liabilities. So what is meant by liability? Liability is that it is the obligation which has to be fulfilled by the company. They have to pay the dues, they have to pay that loan, and it can be paid within 1 year. If it is within 1 year, you have to fulfill that obligation, means it comes under current liability. If you can pay for more than 2 years or 5 years, it's not that immediately you have to pay. That means it comes under the long term liabilities. So current liabilities examples are the creditors or the suppliers, those who have given you credit sanction, credit purchase, they have sanctioned, that will come under the current liability. Bank overdraft facility, bills payable, all those things will be coming under the current liabilities. Outstanding expenses, all those things which are the dues which has to be paid within that accounting year. And long term liabilities more than 1 year, you can, it is not that you have to certainly pay it now. You can pay even after 1 year, so after 2 years, or whatever might be. So generally bank loans are the loans which has been provided by the financial institutions, and the debentures through which you have raised fund. How we for if you have taken a bank loan, how you will be paying interest for that bank loan. Similarly, debenture holders, you have to give them interest. Okay, so yeah, like a loan, for that you have to pay interest, like that only debentures also. Okay, you are going to get your funds through debentures, that's all. Okay, so then it is considered as the long term liabilities. So far we have discussed about assets and liabilities. And next part we are moving to the capital. So this is mostly everyone will be familiar with this term. So once for all, if I am starting up a business, the whatever the amount I contribute or first initially I introduce into the business, that amount is known as the capital. So with which amount I am starting up my business, or which amount I have invested or introduced first for the first time, that amount is known as capital. Okay, so this capital is always I am contributing to the company. So whatever I take it later on from that business, from that capital amount also is considered as the drawings. If I am utilizing that amount for my personal use from the capital, if I am investing 5 lakh of rupees as capital for my business, and if I am taking 50,000 from it from for my family use, then that 50,000 will be the drawings, because last class we have discussed about business entity concept. So capital is always considered as a liability. Okay, why it is considered as a liability means that business has to pay him back, that business has to give that amount back to the owner. So that's what in business entity concept we are discussing all about. So business entity concept, what is it actually saying? Business and owner, they both are different, there is no relationship between them. So every contract we are signing, every transaction we are signing, everything transaction we are recording, everything is done in the name of the company, not on the name of the owner or the name of the proprietor. Okay, so capital is always considered as a liability, that business is liable to pay to the owner back again. So capital, keep it in mind, it is always considered as a liability. And moving to the next one, tangible assets and intangible assets. So tangible assets, already we came across this topic. So tangible assets can be classified into tangible and intangible assets. Tangible assets means one which you can see, one which you can touch, which you can value, give value for that. If I am buying a plant and machinery or if I am buying a furniture, okay, so I can see that. Okay, so I can see that, I can value that, I can touch that. So that is, those kinds of assets are known as tangible assets. Intangible assets are one which you cannot see, one which you cannot touch, only you can feel and realize. So those assets are known as intangible assets. Example, goodwill, copyright, trademark, patent right. So all these and all you can just realize, feel. So take for example goodwill. If you are running a business and I have good reputation in the mindset of the public or the customers, a good brand image has been built by my business, then it's an intangible asset for me, goodwill. Okay, so if you see similarly copyrights, if I have done some artistic work, some painting or music composed by musician, so like that, or if I have wrote some book, so for those things you will be getting from literary work, all those things from, for all those things you can get the copyright. Okay, so copyright, it is also considered as an intangible asset. Similarly, patent. Patent means if you have done some innovation or you have invented some thing, new technology, have brought it, or new product you have produced in the market which has not done by any person so far, or if you have invented a new method of production. Okay, so production product in that itself, if you have done something new, so which is unique and which is not done by any other person so far, so that is known as the patent right. So trademark, suppose if I am dealer, if I am dealing a product, Okay, so I'm giving a AGMARK sign or ISO sign certified some thing logos or something which is I'm just going to differentiate my product from my brand from that of the other product or other brand. So that and all it's unique. It belongs to that specific business or specific firm. Okay, it's not. It cannot be copied by any other person. So those and all can you cannot you cannot touch or you cannot just see, but you can realize or feel whatever the reputation built by you or the brand logo. All those things can be considered as the intangible assets. So assets can be classified into tangible and intangible assets. So tangible assets you can see, you can touch, and intangible assets you cannot touch, you cannot see, you can only realize. Here examples are the furniture, whatever you have in your business, machinery, whatever you installed in your factory, and all those things, land and building, all those things, whatever, those are the tangible assets. Intangible assets means the goodwill, copyright, patent right, trademark, all those things will come under intangible assets. And moving on to the next part is the expenditure. So generally expenses are known as the expenditure. Okay, so what is meant by this expenditure? So generally in a normal course of business, day-to-day business transactions, I will be earning revenue, and at the same point of time I have to spend for certain things. So those whatever I incur, those are known as expenditure. I have to pay salary to my employee. So I have hired an employee means I have to pay him salary, right? Similarly, if I appointed some labor for doing certain, for operating machines or some other work, I have to pay him wages regularly. So those are known as the expenditure. And this expenditure can be categorized into capital expenditure and revenue expenditure. Capital expenditure means if you are doing it now for the first time, one time you will be doing, and you, every now and then you will not be incurring. Okay, so it is non-recurring in nature. You name it as non-recurring in nature. So what is meant by non-recurring? Every now and then you need not do. For example, if I have bought a machinery and I'm going to install that in my factory, so here that machinery initially, if I'm going to incur some installation charges, around some 30,000 or 20,000, whatever might be 10,000. So I'm not going to incur every now and then that installation charges. Once for all, if I'm going to buy means now only I'm going to incur that installation charges in my business. So those expenditure which are not recurring in nature, such expenditure are known as capital expenditure. So I need not every now and then incur. But revenue expenditure is somewhat different. So every now and then you have to incur. Okay, if I am appointing a labor for a daily wages, I have to pay him daily. If he has produced 6 units of output, I'll be paying this much of amount, per unit 8 rupees or per unit 10 rupees. So I have to pay him. So like that, certain expenditure I have to incur daily or on a monthly basis. Like that, I have to incur certainly. So revenue expenditure or those expenditure which are recurring in nature. So every now and then, repeated again and again. But capital expenditure is not repeated again and again. Every now and then we do not incur that. Okay, but revenue expenditure is that we are recurring. Every now and then we have to incur. Okay, so like if I'm hiring a building, okay, to set up my business, I have to pay him rent to the landlord, to that person. Every month I have to credit his account. Rent I have to pay him. Okay, so electricity bill I have to pay. Right. So like this, whatever recurring in nature, those things are known as revenue expenditure. For printing purpose or some postage or like that, some expenses I have to incur every now and then. So you cannot name it as capital expenditure. You have to consider it as the revenue expenditure. So capital expenditure means you will be incurring now once for all. So but benefit will be for the future only. Okay, and it is non-recurring in nature. Every now and then you may not incur. It is not repeated every now and then. But revenue expenditure is repeated every now and then, and you have to incur every now and then, and you'll be paying regularly. It is recurring in nature. This is non-recurring in nature. This is recurring in nature. And next, moving on to the revenue. So revenue means the income that you earn from your business. So whatever kind of operations you are engaging with, from that, if you are going to get any income out of that, okay. So if you are going to purchase from a person, from a supplier, whatever the raw materials or the inputs you require for your business, if you are going to purchase, if you have paid him promptly, means he might give you some discount received, or sometimes for you might earn some commissions in day-to-day your business operations. Okay, similarly you make if you deposit your amount in your bank account, interest they might credit in your account, interest received. So like that you might earn income in your normal course of business. So those are named as the revenue. Revenue or the receipts, we usually name it as receipts. Similarly, expenses we name it as payments, and revenue will term it as income or the receipts we will be saying. Here also capital in nature and revenue in nature also both are there. Okay, receipts itself, capital receipt, revenue receipt is there. Like selling machinery, every now and then you may not sell the machinery, and out of that you won't earn money. Okay, so 5 years or something like that you will be using the machinery or the furniture. If it has got old, then you will be selling that machinery or the furniture, and out of that you will be earning some income or the cash. So those are all capital in nature. So whatever you are purchasing for a long term basis or selling on a long term basis, that is known as capital in nature. Okay, so capital in nature means long-term benefit you are going to earn from that. Every now and then you will not be selling, every now and then you will not be purchasing. So those are called as capital in nature. Every now and then if you are going to incur some expenditure, or every now and then if you are going to earn some receipts, then those are known as capital revenue expenditure and revenue receipts. Okay, so all these terminologies we must know what is actually it is. Okay, so what is meant by expenditure, what is meant by revenue, these all things we must know. Okay, and moving on to the next one is debtors. So this was already discussed. The debtors means one who has got benefit from the business. So if I am a business person, if I am going to sell my goods both on cash and credit basis, cash means no problem. On delivery, the customer will pay me the cash. But on credit basis means they will not be paying me immediately. So they would have got benefit from me, but they would have not paid me immediately. So those person we name it as debtors. Debtors are the person who receive benefit, money or money's worth from the business. Okay, so generally they are treated as assets of the company, because anyhow he is going to pay me. Okay, that is no doubt in that. Okay, sometimes if he doesn't pay only, we consider them as a bad debts. But most probably promptly every customer will be paying me. So then those persons are known as the debtors. Okay, so to whom I have made credit sales, there will come the debtors. Okay, and moving on to the next one, creditors. So quite often people used to get confused with these two terms only. So who is a debtor, who is a creditor? That doubt only most of the students will have in their mind. So creditor is that if I am creditor, you just relate to the supplier. Okay, if I am doing a business, if I want raw material or some other support, even finance support if I require, and getting from the outsider, from the supplier, that person is known as the creditor. He has given benefit. He has given money or money's worth to me. to my business, then that person is known as the creditor. So difference between debtor and creditor, this one. So debtor means if I make credit sales, there comes debtor. If I make credit purchase, there comes the creditor. Okay, and debtor is considered as the asset, current asset, and creditor is considered as the current liability. Creditor is considered as the current liability. Why? You have to pay him back. Now you have got the raw materials and you are carrying out your production process smoothly. But anyhow, you have to pay for the raw materials. If I am going to construct some building or something, and whatever the material I require for building that house or flat or whatever, I may get it on on credit basis from that person. But anyhow, I have to pay him after 1 month or 3 months, whatever the duration he has given me, sanctioned me, I have to pay him back again, right? So that's what creditor means. A supplier, he might have provided me some raw materials or something, money's worth, or even money itself, finance itself, he might give me. Okay, so those people who has given me money or money's worth, then those people we name it as a creditor, and they are considered as the current liability. So debtor is considered as the current asset and creditor is considered as the current liability. Next, moving on to the purchases. Purchases means if I am going to buy a machinery or furniture, then there I won't take it as a purchase. Okay. So while making, especially while recording my entries in journal or whatever might be, I won't consider if I am going to buy an asset for my business, I won't consider it as purchase. I will consider that machinery or that furniture only while making entries. But if I am going to purchase some goods, some commodities, okay, something if I am purchasing and again I am using that in my business and again I am going to reproduce that out, resale. So those things are goods, whatever it is in my business, or when I am going to purchase that commodities, that time only I name them as purchases. So this we have to keep it in mind, because while making entries, you will get confused. So purchase means if I am purchasing goods only, commodities only, I will consider it as purchase. If I am buying a machinery or if I am buying a furniture for or land and building something, if I am purchasing, then that is not purchase. You have to debit that account. Machinery account debit or land and building account debit, like that only will be making entries, recording entries, that we can see later on. So purchase means goods or the commodities or the merchandise that is belonging to the company, that is purchased by that business. And sales, sales again only if you make sales of goods, goods if you are selling out, or some commodities if you are selling to the customer, then that one only will be considered as sales. Not selling out a machinery or selling out a furniture or selling out a plant and machinery, land and building, all those are not sales actually. So that also you have to consider here. So sales means here you are going to consider only the goods or the commodities that you sell to the customer. And again, if you see this purchases and sales, both you have cash basis, credit basis. Cash purchases, credit purchases. Similarly, cash sales, credit sales, both are there. Cash means what, credit means what, most people know, right? So cash means immediately if I'm purchasing, cash purchases means immediately if I'm purchasing, and immediate on delivery if I'm going to give the payment to that supplier, then that is known as cash purchase. Okay, so 10 units of stock or something if I require from the supplier, I'm getting it, and immediately on delivery if I'm paying, means that is cash purchase. Similarly, credit purchase means on if I am not able to enough for a strong financial position, if I am not able to pay them immediately, and I have got some excuse or some agreement there between me and supplier, I can even pay him later on after 1 month or 3 months, whatever might be. So that is known as the credit purchase. So immediately on delivery, you will not be paying cash. So that we have to have it in mind. Later on, how to record entries and effects, how it will be, we can see. And sales, if you see, again it is cash sales and credit sales. Two types of sales are there. Cash sales means if you are going to sell the customers and customers is immediately paying to you, then that is known as cash sales. And credit sales means for that you will not be receiving the amount, might be you will might pay later on to you. Okay, so that only you are naming it as customers credit debtors, you are naming it as those people only we name it as debtors. Okay, so credit sales means immediately you may not receive cash for that. You might receive a payment in future from that customer or the debtor. Okay, so hope everyone would have understood so far what is meant by debtor, what is meant by creditor, purchase means what, sales means what we have to consider here. So only if you know this terminology, you can record the entries, everything you can make. So base, you should be strong enough in that, then only you can go for further. Next, moving on to the stock. So what is meant by the stock? Stock means usually it right from the beginning till the end, it reaches the customer. Whatever you have it in your factory, that is known as stock or the inventory. Okay. So if you are going to buy some if you are owning a garments factory or something, if you are going to stitch shirts or something like that, basic thing whatever you are going to buy from the supplier, that is the stock. Similarly, if you have manufactured that, if it has undergone several production process, then again you are going to have it in your hand, it is ready for customer delivery, that can also be termed as stock. So whatever the goods which are there with the business, which are there with the factory, that is known as the stock. It may be stored even in warehouse, go down like that, or it may be in the factory also. So that is known as the stock. Okay, so right from whatever you have purchased, some cotton or wool or whatever material you have bought, so that raw material also stock, and whatever carried out for production process and it is waiting for delivery to the customers, that can also be named as the stock. Okay, so it is ready for delivery to the customer. Okay, I have stitched a shirt, pants, all those things, and it is ready for delivery to the customers, that can also be named as stock. So stock, otherwise known as inventory. Okay, and it can be classified into opening stock and closing stock. In our accounts we named these two terms. Why? In the sense, if at the beginning of the year, if a stock is there, what is the worth of it? Say for 3 lakhs or something, so that we must know. Opening stock means if a financial year is right from 1st April to 31st of March, means 1st April whatever the stock in the business is known as the opening stock, and whatever at the end of the financial year, that is on 31st of March, whatever at the end of the year, that is known as the closing stock. So let me repeat once again. Stock is otherwise known as inventory, and stock, it is the goods which are remained unsold. You are not you're just ready. Okay, so those are named as stock. It is also an asset of the company, and specifically if you want to tell them, it is the current assets of the company. Okay, and then what is meant by opening stock and what is meant by closing stock? Opening stock means if in a financial year April 1st to 31st of March, means April 1st is will whatever stock lying in the business is known as the opening stock, and 31st of March, whatever the stock is lying in the business, that stock is known as closing stock. And other terms, it will be easy for you: profit, loss, all those things you would have heard. So whatever I'm selling out more than price, than whatever it is actually book value, more than that, if I'm going to sell, obviously I may earn profit. Or whenever my expenses are less, and my income or the receipts, revenue are more in my business, then obviously I'll be earning profit. This is a normal thing. If I have bought a bike or something for 70,000 or something, some furniture or something, whatever might be. So if I am going to sell more than that, then obviously I will be earning profit. And And loss is that if my expenses are more in my business, my commitments are more in my business, like I have to pay rent, electricity bill, lot of commitments are there for me. But whatever I earn, whatever the revenue or the income that comes to my hand is very very low, means then obviously I'll be incurring a loss. Okay, so this can be termed as profit or loss. And drawings. So drawings, already we discussed this. So whatever, if I am investing the capital from my hand, I'm going to invest in my own business also. Even then, if I am going to withdraw some amount for my family or personal use, then that will be considered as drawings. Drawings can be in the form of cash also, or sometimes goods also we might take for our own use. If I am running a supermarket, I might some goods or grocery items I might even take for my even my family use there. Okay, so goods also, they some proprietors will be withdrawing from the business, so that is also considered as the drawings only. Sometimes I may take cash out of the capital whatever I have invested. Okay, so that is also considered as drawings. If it is for office use, then it's not considered as drawings. But if I taking for my personal use or for family use, then that is known as drawings. And next, if you see, bad debts, provision for bad and doubtful debts. So these are things when it will come into picture, you know. So generally when I sell goods on credit. Okay, so already we discussed about sales here. If I am making cash sales, then no problem. Immediately on delivery, I'll be getting cash from the customer. But if I'm going to sell my goods on credit, then only I can see large number of customers. Okay, because many people they may not have instant net cash on their hand and buying the product or buying the goods from us. So if I'm going to make a credit sale, then obviously there is risk for me. Risk level is more for my business. There might be lot of uncertainties that customer may not turn back again, or he may not pay promptly on the particular date. Like that, many things are there. If he is making prompt payment, then it is okay. Then I might allow discount, some discounts also to him. All those things will happen there. But if he is not returning back, or if he is paying very delay, or at a certain point of time, yeah, I think that he won't pay me back again, then that is considered as bad debts. Here there is a risk of loss, that debtor, that customer may not turn back again, or he may not pay me again. Okay, so 1 lakh worth of goods I would have sold him on credit, but that 1 lakh I couldn't get back again, or 50,000 or something. Okay, so if I am not able to get from him, then that risk whatever I'm facing is known as bad debts. Okay, and provision for bad and doubtful debts. Sometimes we may not be sure whether he may pay or he may not pay to me. Okay, so that condition is for that you'll have to make some provisions. So it may happen or may not happen. So it's entirely you cannot predict about that. So that time you have to consider for provisions for bad and doubtful debts. Some debtors may turn up back again and pay promptly, for which we might allow some discounts also. Some debtors, they won't even surely give you. If you are confirmed with them, then you can treat them as bad debts itself. Then it is a risk on your part only. But some customers, some debtors, he may pay or may not pay. We cannot predict exactly what will happen. So anyhow, we have to adjust that. So we have to create some provisions for that, because our profits, everything we should not boost up and show in our balance sheet or something. Okay, so balance sheet, assets worth, or properties, everything, whatever your profits, everything should not shoot up in your financial statements. So you have to create necessary provisions for all these things. Then only you can reduce the profits. As we already discussed in conventions yesterday. So conventions of conservatism. So to what extent genuinely, if it is possible for you to reduce your profits and show by making certain provisions, you can do. So that is the convention of conservatism. Actually, it is. So like that provision of for bad and doubtful debts, why you are making is that he may pay or may not pay. You are not certain about that payment. So anyhow, you can create some provisions for that. That is known as provision for bad and doubtful debts. In this, if he is in this, I am fixed like 40,000, I won't receive back again. If suppose if he is paying means, then I might also give again discount to him. So that is known as a provision for discount on debtors. We will be naming it as. Okay, so all these will be seeing in the final accounts actually. Okay, so final accounts will be discussing provision for bad and doubtful debts, bad debts, and then provision for discount on debtors. Good debtors will always receive a discount from the company. So for them we'll be providing provision for discount on debtors. Similarly, provision for discount on creditors also there. Okay, if we are running a business, if you are going to get a credit terms from a supplier, some raw material or something, you are going to make a credit purchase. If you are paying promptly, he might also give you some discount. Okay, so that is known as provision for discount on creditors. So like this, you'll be having lot of terminologies in our accounting subject, which we must know. Okay, so before going on to making entries. And understanding the transactions, making entries, how to post it, all those things. Before that, you must know certain things. What is meant by debit? What is meant by credit? What are these terms known as?